As a firm, we really have what I'd call an arbitrage mentality. Instead of trying to beat the market by looking into a crystal ball and picking stocks, we focus in on ways we can invest into the market at a discount. It's a different way to approach investing, but one that we believe offers a more tangible and more durable path to beating the market over an investment cycle. Now, how does this approach work in practice? Well, instead of owning a stock that we think is cheap and the guy that sold it to us is wrong, we instead find baskets of stocks and bonds and other financial assets, all of which are trading at a discount to their underlying tangible value. And that discount, that then forms the source of our outperformance or our alpha. And as a firm, we have a long track record of capturing that discount for our clients. In terms of finding our investments, we spend most of our time involved in the closed-end fund space. Closed-end funds are listed investment vehicles, similar to a listed investment company in Australia. Internationally, it's a mainstream asset class. There's over $500 billion of market capitalization and literally thousands of different vehicles providing access to bonds, equities, and just about every other asset class or country that you could think of. And what's interesting about these securities for a firm like ours is that they typically trade above or below the underlying value of their portfolio. And when they trade below that fair value, which can happen for a variety of reasons, the discount that offers, that can present a really exciting opportunity to invest into the actual underlying asset class, whether it's US Treasuries, Asian equities, or Australian infrastructure assets. Those discounted opportunities allow us to create an attractive, diversified portfolio of international assets, all at a discount to what the underlying pool of assets is actually worth. Now, it's important to say we're not wedded to the closed-end fund sector. We can find the same sorts of attributes that we're looking for in things like holding companies, convertible bonds, and sometimes listed equities. But the principle of how we approach investing, only buying assets at a discount, that's always the same. The first thing to say is that this is a bit of a specialist skill set. Finding assets trading below their tangible value, and then importantly being able to capture that value for your investor. It requires approaching the market from a different angle. We have a range of techniques that we use, but broadly they fall into two different camps. Passively being able to capture a discount, or actively taking advantage of a discount. On the passive side, we have a range of proprietary systems that we use, and these allow us to capitalize on things like tender offers, share buybacks, and other liquidity events. These sorts of corporate actions, they allow a skilled investor to capture some of the underlying value in their portfolio. We also have the ability to exploit trading opportunities that come up in the market from time to time, and that we see sitting here in London. The closed-end fund space in particular is often driven by changes in investor sentiment, and the volatility this can create in terms of discounts and premiums. It's a great area for a firm like ours to exploit. Now, while we have a lot of clever ways to capture these discounts using passive techniques, active strategies and corporate activism has always been one of our key tools. And when you talk about activism, it's important to understand that there's a wide range of options available to managers that know how to engage in these sorts of strategies. It's also important to say that there's a lot of guys out there that like to beat their chest and call themselves activists without really understanding what's required. Our philosophy is a bit more refined. Speak softly, but carry a big stick. When major corporate action is required, we have considerable form in getting the best results for our shareholders. However, we only ever employ the more extreme measures when reasonable attempts to engage with a board or a management team have failed. And in practice, there are a lot of ways to achieve the best results for shareholders without having to reach for the more aggressive measures. Most boards genuinely want to see the best outcome for their shareholders. They sometimes just need a gentle push.